Hello, everybody. Welcome to this weekend's episode of the Weekly Wrap. This is our 6th episode of this, and a couple weeks ago we had an episode that was really focused around the record bearish sentiment that were in the markets, and deservingly so. I mean, there was a lot of macro and things happening in the markets that kind of validated that sentiment. But usually in markets, when sentiment swings really heavily one way, the price might go the opposite way. And now we have a lot of bullish sentiment coming into the market. And after we published that video on how much bearish sentiment there was, we hit the bottom and then have been rallying since then. So now the opposite is going on. We have a lot of bullish sentiment coming into the market, and is it too early? So one thing I want to start on is last week we pulled up this chart on the right, which said that since the pandemic, we have recovered all jobs that were lost. And we had some questions around that number because it didn't really feel like the labor economy was as strong as what the Fed was saying. And this week we got these charts from the Labor Department saying that the share of U.S. population looking for work or working has actually decreased since the pandemic, and has not recovered, and is actually going back down in 2022. So what does this tell me? Obviously, there are less people that need to work in total. There are some people since the pandemic that have retired or no longer need to work, and it's not because of the stimulus, it's not because of unemployment. All of those benefits are now gone. So there's no more people living off of those unemployment packages that we had during the pandemic. That's gone. So it's not that those people aren't working. In my opinion, if these numbers are in fact factual, which we will assume that because it's from the United States Labor Department, there's a growing disparity between these two populations. And I think in a nation when you have a population or a demographic that's growing, that is financially free and doesn't need to work anymore, and is contributing to the economy through whatever business that they have, or investments, or real estate, or whatever, and then you simultaneously have a demographic that's growing and taking on multiple jobs, and can barely make ends meet, and those demographics are both growing at the same time, I think there's something wrong in your economy, and there's just something wrong fundamentally with how the society is working. So obviously what these charts are showing us is that since all of the jobs have been recovered since the pandemic, but there are less people working since the pandemic, then that means there are a lot of people taking on multiple jobs trying to make ends meet. And at the same time, the people that we lost from the labor force are no longer needing to work. So that's something that's concerning to me. I think it was convenient that they put out this chart to the right about payrolls, that we'd recovered all jobs lost, and that happened right before the inflation number just came out, and is really allowing the Fed to continue tightening by justifying it with all the jobs being recovered, saying that the labor market is strong. But the labor market is not strong when you have tons of people working multiple jobs just trying to make ends meet, and they're probably not working great jobs either. And then you have this other demographic of people that no longer need to work. To me, that does not signal a healthy labor market, and it does not signal a healthy economy. So while the markets are rallying, pricing in a Fed pivot because they think the economy is going to strengthen, that we've seen the worst of inflation, this would just be a small little warning sign that tells me that maybe things aren't as great as they seem. So with that, there's a lot of risk on coming back into the markets, but there are some fears lingering that we have here on the right side too. So stocks reached another milestone in their comeback last week, with the NASDAQ composite rising more than 20% from its mid-June low to end its longest bear market since 2008. So the NASDAQ index is officially in a new bull market. We're up over 20% from the June low. The rally has stirred a familiar debate. Will the rebound continue? some investors are starting to believe the worst of this year's rout might be behind them. Data last week showed gauges of both consumer and producer prices falling in July, offering some hope that inflation might be at or close to a peak. So if we take a look at this chart below that quote that I just read, it shows some of the most popular risk-on assets. So we have some of the meme stocks. We have AMC Holdings at the top. We have Coinbase, which has been a risk-on asset. We have the ProShares Ultra Pro QQQ, which is basically just an index of the NASDAQ. We have ARK Innovation, that is Cathie Wood's fund, and it holds a lot of stocks like Coinbase, a lot of hyper growth stocks. And then we have that overlaid with the S&P 500. And you can see that all four of those assets are actually beating the S&P 500 over the last couple months since the June low. And really, what does that tell us? Well, that tells me that people are getting a little bit more confident that we've seen the bottom of the market. They're piling into these risk-on assets. They're piling into these assets that should, in a bull market, if we have seen the bottom, should outpace the S&P 500. But what are people still worried about? You can see the biggest worry that investors still have is that inflation has maybe not peaked. It says here that inflation has probably peaked but require persistently tight policy. Okay. Excuse me. So this top one is inflation, but it's inflation from the standpoint that it has probably peaked but will require persistently tight policy to decline further. And I think that's the most justified worry that most of us still do have, is that the Fed is not at all done tightening this economy. And then the second worry is growth. A recession is an inevitable consequence of policy tightening. So it's kind of a carry-on of the first worry, is that growth is going to have to slow down if the Fed keeps tightening. And we've already kind of seen that in this past earnings report. I do believe that was the beginning of growth kind of slowing, and that we will see that persist through coming quarters if the Fed keeps tightening the way that they're tightening. We have growth that the global economy is already sharpening slowly. So some people are worried about growth already slowing sharply. And then we have some people who think that inflation has not peaked yet, and that's definitely a possibility as well. We saw that groceries and housing are still surging. Really, the only thing that came down that brought the CPI down was the price of oil, gasoline, fuel. Everything else was still really, really bad. And then the last worry was financial markets. The shock in rates and credit spread widening is a major risk. And I think that risk gets higher with every tick up that the market goes. So since the Fed's July policy meeting, some investors have bet that the central bank will pivot from raising interest rates to lowering them next year to boost economic activity again. That has helped spark a rebound in not just stock but also bond prices. The 10-year U.S. Treasury yield, which falls as bond prices rise, fell to 2.848% Friday, down from its mid-June peak of 3.482%. So that's really pricing in Fed cuts, and that's a pretty sharp decline to go from 3.482% to 2.848%. So people are really starting to price in this Fed pivot. And at 8.5% on the CPI, and having food and shelter still surging and at its highest level since the 70s and 80s, I don't think we should be near. I think it would be a massive mistake if the Fed pivoted, and I hope they're not that stupid. I would rather the markets be wrong than the Fed make a huge mistake. So I do think if the Fed does the right thing, that they're not even close to being done and that they need to tighten this economy a lot harder. Continue to raise it by 0.75% throughout the foreseeable future. So, have we really seen peak inflation? So this chart here on the left shows the year-to-date change on the three major indices. We have the Dow Jones Industrial Average, which is down just over 5%. We have the S&P 500 down 10%, and the NASDAQ down about 16%. But the NASDAQ has entered into a new bull market. The NASDAQ was down about 31 or 32% earlier in June and has since rallied into a new bull market. So as you can see, since that June low, the markets are really rallying heavily and have continued to do so, pricing in this Fed pivot. So skeptics, however, warn that it might be too early to assume that the Fed will change tacks in 2023. July's CPI and PPI readings were good news for the markets, and they certainly gave wind to the idea that the Fed will raise interest rates by 0.5 point at its September meeting instead of 0.75 point as initially expected. But there's a flip side to that on the right side here. So the shifting odds. So the odds really, all this chart says is that the odds are shifting. That it used to be before the CPI reading that it was going to be more likely that the Fed was going to raise rates by 75 basis points than by 50. And after that meeting or that number came out, it is now more likely that the Fed will raise interest rates by 50 basis points rather than 75. But let's take a look at this quote underneath that chart. But just one or two lower inflation readings won't suffice in convincing the Fed that inflation is dissipating, said Nicholas Cullis, co-founder of Data Trek Research. And, that's really what we've seen from people who work at the Fed, people who are voting on this. They've really said that the fight is not done, that they need to see better numbers, more consistent trends to even think about cooling off this tightening phase that we're in. Some factors driving inflation higher have also yet to ease. Last week's CPI report showed grocery prices rose 13.1% in July from a year ago, the fastest pace since 1979. Housing prices also increased. So, other than fuel, what are the two things that you need? You need groceries and you need housing. And those are showing no slowdowns yet, and they're really too high. I don't think the Fed can let this persist. They can't let this persist. If you let food and housing get out of control, that's when you start getting riots, you start seeing political revolutions, you start seeing violence. And I think the government just knows that that's more important than boosting the stock market. Given the way the Fed typically likes to see multiple consecutive economic readings before changing tack on policy, markets might be running ahead of themselves, Mr. Cullis said. And I would have to agree. Even though that headline number went from 9.1% to 8.5%, not only is that just one reading, that doesn't show any type of trend that we're headed lower, that we've seen the peak. We're still seeing food and housing at really dangerously high levels, and I think that's something that the Fed can't accept. So now I would just want to hop into some charts. This first one, we have the S&P 500 on the top, and on the bottom we have smart money and dumb money. So the dark brown red line is dumb money, and what that means is retail traders like you and I and everyone who buys stocks on their brokerages online. And you can see that level is really, really increasing with this bull market. So typically you'll see dumb money just follow the market and buy more as it goes up. And we saw smart money really piling in through this year. And it's kind of started to decline now that the markets are rallying. The institutional investors, the hedge funds, Wall Street, they're not convinced that this is a sustainable rally, and if you see less money going in from institutions, then they believe, and they have more information and power than we do, they believe that there are better prices that are coming that they can put that money in at instead. So we can see that when the smart money slows down, if you take a look at the thin blue line on the bottom and then compare it to the S&P 500 on the top, when the smart money slows down, there's usually better prices coming in the distant future. So, and vice versa, when we see dumb money piling in at really fast rates, take a look at the end of 2021. Usually there are big declines in the market, and Wall Street takes our money, and then they put that back into the market at better prices. So you have to be careful when you see something like this, especially when dumb money crosses over smart money. It's just an indicator that I like to look at. So with that, this also kind of tracks the sentiment in the markets. We have the put to call trading volume. So this isn't a 100% effective indicator, but it is something useful, especially in this bear market. So we've seen, first of all, when this blue line is lower, there being more calls opened than puts. So people are feeling like the markets are going to go up and want to leverage that. The last time we saw it spike at this 0.7 level was in March. And in March, we saw a peak in the market and we saw a really sharp sell-off. So if we're still in this bear market decline in the S&P 500 and we're back at this 0.7 on the put to call ratio, we have a lot of calls being opened compared to puts. There's a lot of money to be made on Wall Street if they close those calls worthless. And to do that, they would need to push the markets down. When sentiment, like I said in the beginning, when sentiment goes too heavy one way or the other, just take a look at the COVID bottom, actually. Look how many puts were being opened. And that was right at the market bottom. So all of those people got burned and had to sell for a loss or had their contracts expire worthless. And that's usually what you see when sentiment gets too heavy one way, is Wall Street will have to swing the prices the other way. And we're seeing a lot of calls being opened right now, a lot of euphoria on the markets, a lot of people fearing that they may have missed out on all the market gains. And when you have a lot of FOMO in the markets and people just piling in because they feel like they missed out, that's usually when you see the markets get burned. So we have two varying types of S&P 500 recoveries charted here, and they're charted as in the average after a bull market peak and a decline of 18% or more. So what these charts track is one tracks when we go into recession, one tracks when we don't go into recession, and it goes from a bull market peak to an at least 18% decline. So in a recession, you can see is the blue line. And you can see that usually after a rally that we've seen from like we're in right now, it'll go back and revisit that bottom. Now what happens after that depends on the individual case. Obviously every economic situation is a little bit different, but in a recession type scenario, usually we'll see a retest of the bottom. And if we're not in a recession, then you kind of see more buying and you'd see more upside. Now, I guess the question would be, are we in a recession? We have seen 2 consecutive quarters with a decline in the GDP, and typically that would indicate that we're in a recession. Now, the reason people say that we're not in a recession is because the labor market is too strong. But what did we just show you at the beginning of this episode is that while we may have recovered the number of jobs that we lost during COVID, we don't think that those are good jobs. And additionally, we know that there are less people in the labor market right now than before. So is the labor market really super healthy? I don't know. And I think if you have another quarter of declining GDP, 3 consecutive quarters, I just don't know how they'd be able to spin that we're not in a recession. So I think it would be reasonable if we did see a retest of the June lows, whether we saw a new low or not. We can't determine that, but I think it would be reasonable to expect a return to the levels we were at in June and see this market cool off rather than continue to surge. Additionally, we are in a midterm cycle. This is year 2 of a presidential cycle, and this chart shows the averages of the stock market during those years. So obviously in May and June and September, those are really, really the worst months during the midterm cycles, and we saw big sell-offs during May and June. We actually saw the bottom in June, and then we saw the rebound in July, which is also consistent with this average. And what do you see in the end of the year? So around election time, you see the markets really pump. You see the politicians, the people who are in power, trying to make people's wallets a little bit fatter, make them a little bit more content with who is in power, and hopefully sway their votes. So while we may see As you can tell, September is usually a pretty bad month. It's actually typically the worst month in a midterm election year. That would be where we're heading in the next couple weeks, and we're also at a big resistance on the markets. So history would tell us that it would not be strange for us to see another sell-off in September, followed by some gains in the end of the year as we get around election season. So now let's take a look at some stock charts. I want to take a look at Cathie Wood's fund ARK. And this was something that I was looking at this week. So if you take a look back at the beginning of 2021, actually, let me back up for a second. So Cathie Wood's, if you're new here, so her fund tracks what she deems to be innovative companies that are going to disrupt the economy, that are going to change the way that we live, the way that we do business. But really, these companies are hyper-growth companies. They're usually not mega caps. They're companies that are kind of in the beginning of their life cycle. They're not really established. They're maybe just beginning to generate profit. And typically, you see these being the most affected by interest rates due to the fact that there's not consistent revenue or dividends or anything like that. They're typically newer companies. So it was kind of a leading indicator going into this bear market. You can see in 2021 we had a sell-off and then kind of sold in a range. And while this was happening, the market was actually, the S&P 500 was continuing to go up pretty sharply. And it wasn't until the beginning of 22 that we saw the markets decline on the S&P 500. And obviously, we saw that capitulation in this fund, Cathie Wood's fund. When that happened, it sold off even harder. But really, what are we seeing now? We're seeing the beginning of a rally, a big rally. I believe this fund is up over 40% from the low. So it's really leading the markets. These stocks are gaining the most, and these were the stocks that were losing the most in the bear market. So while the market could go down in the coming months, this could be a leading indicator to say that the market as a whole is beginning to just turn. It's just something to keep an eye on. I was looking at it. It did look like it was somewhat of a leading indicator, just these types of stocks going into the bear market. So you'd expect the same going to bull market. You would expect these to turn earlier since they were beaten down for longer, and you'd expect them to have bigger gains since they led in losses. So I just want to take a look at that. It's also at a resistance right now. Obviously, this is a really big level for it. It bounced off of its COVID crash lows. So if we do see a sell-off in the market and in this sector as well, I would be really surprised to see it go below that level, as it respected it during the COVID pandemic crisis and during this sell-off as well, falling all the way from $156 to about $38, which is kind of insane. Right now it's sitting at about $52.01. So let's take a look at Apple. Apple is just absolutely obliterating the market. It's almost back at its all-time highs. Every single resistance level we've had for Apple, it's just blown right through. It continues to keep buying sharper and sharper. As you see, this trend line that we've had on it now for 3 weeks has yet to be breached. And it broke through this last level of resistance we had before the all-time highs. So if Apple doesn't sell off in the beginning of next week, I would expect it to make another test of those all-time highs around 180. And obviously, we would look now this 170, about 169 to 171 level to be support. We would expect this trend line to be support. And then if it breaches through that level and heads to the downside, we have our levels of support mapped out there. But really, this has been leading the markets higher. Obviously, this is the heaviest weighting in the S&P 500. This is the heaviest weighting in most tech indexes and growth indexes. So if we see a sharp cool off or decline in Apple, it could lead the markets lower. Will we see a new low on Apple? I don't know. That would be a really, really big decline. And if we did see a new low on Apple, the markets would most likely also be making a new low. So this is just something that I like to keep an eye on to gauge the stock market. Obviously, at some point, Apple's going to need to come down and cool off. I mean, it's been rallying really, really hard with just no pullbacks, and that's obviously just not sustainable. Where that will happen, we obviously don't know, but we're going to keep an eye on it. We have this trend line that's been on there for 3 weeks now, and it just continues to outpace the markets. It's the largest company in the world, yet it's growing faster than not any company in the market, but it's growing faster than the market. So that's just something that I find to be really, really interesting. Let's take a look at the S&P 500 now. So the S&P 500, we drew this trend line actually last week. We said, it broke through our last trend line. It looks like it's going to get through the Fibonacci, that 50 level, recovering 50% of its losses. But now it's touched that trend line where we said, hey, you know what? If the stock market really gets crazy, this is a level we'd expect some selling. And it's coinciding with a big horizontal resistance that we mapped out as well. So this was a point of support multiple times. It was supported back in October. It was supported in February. It was supported in March twice. And then when it broke through, it was resistance in June, which really sent us to the low. And now we're retesting that. So this is a huge level on the S&P 500. Obviously, if we break through this, I would be expecting, I have the Vanguard 500 pulled up, but I'd be expecting the Vanguard 500, the VU, to be heading back towards that 420 level, which would be really, really high. We'd be in a bull market on the S&P 500 at that point. So I think it would be reasonable to see some selling here on the S&P 500. If we breach back through this zone, I'd expect to get to the top of that low point from June. So that would be around 362, 360 on the VU. Obviously, this tracks the exact same as the S&P 500. And I just think we're at such a critical level right now. We're really high above that moving average that's been respected on the S&P 500 typically. And I just think we're due for a cool down. Whether we do head into a bull market or not, I just think it's reasonable to expect a little bit of a cool off here on the market. So, I just think also it's really interesting that this trend line got hit. I know we mapped it out a couple weeks ago saying that, hey, man, if things really get out of hand, I'd expect this. And now we're here. So this is really a big turning point. Bitcoin, it's still in no man's land. The good news for Bitcoin holders is that it's kind of just slowly grinding higher. I have this trend line on it, similar to the one we just saw in the S&P 500, that I would say, okay, we continue to rally. Where would I expect some selling pressure? I'd expect it whenever it meets this trend line. And if it breaks through that trend line, then I'd expect it at around that 28,000 to 30,000 level that we've had mapped out for a while as well. Obviously, I think Bitcoin is really important. It's a really good diversifier, especially in the environment that we're in right now. I think it's important just in general in finance to own various diverse assets. That way you're never susceptible to one market kind of crashing and you losing a lot of your net worth, a lot of your power there. So I think Bitcoin is some place where you can diversify. Obviously, real estate is a great diversifier. Stocks, cryptocurrency, whatever business that you might have, obviously, good diversifiers of wealth. And I think Bitcoin is a great place to be, especially at these prices. We're down so much from the top. You're getting a discount on Bitcoin on something that's still very, very early, adoption-wise, technology-wise, just knowledge-wise. A lot of people don't really understand Bitcoin. They don't really understand the implications that it'll have on our economic system, on the monetary system, internationally. And if things really do come to fruition on Bitcoin, there's just exponential gains for decades and decades to come on it. And that's something to be excited about. So I think it's a really good diversifier. Obviously, it could head lower if we bounce off this trend line sell off, but you're still getting a discount on it now nonetheless. And it's a good thing to have, especially the way that our geopolitical situation, obviously we mentioned this a lot. You have the power to be your own bank with Bitcoin. You can put it in cold storage. You can have it on a hardware wallet, and no one can control your money at that point. You can't get it confiscated. You can't get it censored. It's really hard for governments to track your Bitcoin and figure out where it's at. Almost impossible. So there's a lot of value there and it's new. So the knowledge really isn't there yet. But I'll cut the episode there. We're just over 30 minutes right now. I want to thank you for joining me today. As always, I think we get a lot of information out of this weekend episode. This week will obviously be really big. We'll be watching the S&P 500, which is at a really big resistance level right now. Will it break through? Will we continue? Will we go into a bull market on the S&P 500? Or will we head back down lower and revisit those June lows perhaps? We're going to have to see. It's going to be a really exciting week in the markets. If you're watching on YouTube, be sure to subscribe, tell your friends about it. And if you feel like you want to support us, there's a link there that'll lead you to a support page. And be sure to follow us on the podcast. And if you're listening on the podcast, be sure to follow us. There should be a support link in the description of the episode. And head to YouTube and just give us a subscribe. That would mean a lot. And if you want to see some of the graphs that I'm talking about, some of the quotes, and you listen on the podcast, then just head to YouTube. So thank you for joining me today. We'll be recording Daily Dose episodes all week following the stock market, and we'll be back next weekend for another weekly rep. But other than that, thank you for watching. Thank you for listening, and we'll see you in the next one.